From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first Friday of August, 2024. The State Fair is underway and will run as usual through next weekend. You should go to the fair because the Brewers are out of town all week. And this weekend, Comedy Sports is celebrating its 40th anniversary with a World Championship tournament. That'll be fun. We have some strange stories to pass along today. First, let's start in Scotland and the medical school at Edinburgh University. They've enrolled 2,000 more students than last year. And because of that, they've run into a unique problem. They've run out of cadavers. That seems like a big problem for a medical college, sharing a cadaver. Isn't that how Frankenstein got started? The Japanese company that produces the wildly popular Hello Kitty has announced that Kitty is not a cat at all, but actually a little girl. This is either a huge promotional campaign to sell more toys, or their animators really suck. We haven't had a headline of the week for a while, but we're in luck today. Headline: heat-stricken tourist in Death Valley airlifted to hospital after skin melts off of his feet. Here's just a reminder from your friends here at Money Talk. If you're thinking of going to Death Valley, again, Death Valley, wear sensible shoes. On the podcast today, we have Dave Sandstrom, Art Rothschild, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. A bit of a death valley for markets this week. The NASDAQ down 3.4%, down 582 points. The S&P 2.1% decline this week. That's 113 points. And the Dow Jones Industrial Average down almost 1,000 points at points in time on Friday for the week, but finished the week down 855. That's 2.1%. After losing 613 points on Friday for the year, Dow up still 6.5%, the S&P up 13%, the NASDAQ up 12.2%, all including dividends. Big move lower on Treasury rates, even short-term 13-week Treasury bill moving from 5.16 down to 5.03, and the yield on the benchmark 10-year U.S. Treasury all the way back down to 3.8. Started the week at 4.2%. That's a quick look at the week from a numbers perspective. You know, Art, I think I'd be remiss if maybe we didn't start the conversation this week on just the volatility in stocks broadly. It was a tough week overall, but I think we got to keep maybe some bigger picture in mind.
Yeah, I'm going to call it the lemming effect. Everyone, jumps off the cliff at the same time, running after who knows what. This week, it was a little bit of bad news, which I know Joel will go over with respect to the labor markets. Despite some good implications or inferences that could be drawn from the things that Chairman Powell said after this week's FOMC meeting. So it's clear that we're no longer as concerned as we were before about inflation, and we're getting more and more concerned about a weakening economy. So, and especially labor market. And so the markets all of a sudden decided that instead of just the sign of a little something happening, that it is time to jump off the cliff. I mean, they're literally trading as though we're going to have a recession because of just a few data points that you don't know how they're going to repeat. So I think it was just a normal week as far as I'm concerned. And coincidentally, as we were talking about earlier, last summer we had a correction. We've been going almost straight up for the past year, made money 8 out of the past 12 months. As you indicated, we're still up for the year in the S&P, which really counts, and the NASDAQ that's been really exciting. So a little volatility, good. Get the people who shouldn't be in the market out of the market and let the rest of us make money over the long haul.
And Art, it's also a stark reminder that you have to, be prepared for how quick sentiment can change. Because I look back and really in recent memory, it wasn't long ago where people were cheering bad news because they were hopeful that the Fed would start to discuss the possibility for rate cuts. And here we are at the first sign of bad news in earnest, and suddenly we get a tremendous sell-off, which so again points to the fact too that good luck trying to time the market.
I think bad news maybe not precisely historically how we would characterize it. Certainly not good news, though. And Joel, Art kind of told you what you're going to be talking about here. Maybe tell us a little bit about the labor report today, because I think it stole all the headlines in a week in which the Fed spoke. That's pretty atypical. And yet we got a labor report today that, again, maybe not bad news, but definitely not good.
As Dave said, it's all the perspective you take, right? I mean, and the numbers that came in today were worse than expected. So that's, so you start with the expectations and you go from there. But we had the employers added 114,000 jobs in July. Sounds pretty good. But it was the second lowest number that they added in 43 consecutive months of adding jobs. Now, I slowed down there because, that's pretty good, 43 months in a row of adding jobs. But it was just 114,000. So now all sorts of people are, I was reading online today of economists saying, oh my gosh, well, this is too bad. The Fed might have to raise rates higher than we expected, sooner than we expected. Lower. Yeah. Thank you. And that we're maybe we're in a recession. So what we see is what you were talking about last week on the podcast, is that we're seeing weakening, but we're not weak. The unemployment rate went up to 4.3%, which is the most it's been in almost 3 years. But it's still relatively low, historically speaking. And a lot of the people that added to that higher unemployment rate were new entrants. It wasn't people losing their jobs as much as it was people who had been on the sidelines saying, you know what, this looks like a pretty good time to get a job. And so they weighed in, and the way they count unemployment, that's raising the unemployment rate.
I think it's so interesting when we look at things like unemployment rate, when we look at job growth, and we're talking about things like growth, and we're talking about unemployment rates that are far slower than or far lower than unemployment rates that we saw even in good times in the past. And so I think, if anything, it's a reminder that the last couple of years were so heavily influenced by an economy we'd never really experienced before, one that was deeply, deeply impacted by COVID shutdowns, that then was impacted in the other direction by all these restarts. And it may be fair to say that it's not that the economy's now bad, it's just back to post-COVID normal.
There was mention of a SOM rule today, and it was an economist who used to be on the Federal Reserve who came up with this number where if you look at the last 3 months of the average unemployment rate, and if that was so much higher than the lowest rolling 3 months of the last 12 months, that indicates that you're in a recession. And so people were pointing that out today, saying, hey, we're in a recession because of this rule. And the economist who came up with that said, yeah, I don't think so. Just because things are so different now, because this is an economy that's still riled up from the COVID pandemic.
Yeah, rules meant to be broken for sure, and maybe that's one of those cases where we don't have great comparisons, whether it's year over year, whether it's looking at the last couple of years of data. There is no reason to believe any of that was normal.
All that said, though, there were figures in these numbers today and throughout the week that show that the economy is slowing. That we had one of the things that I like looking at are the temporary help jobs, because historically that's sort of been a harbinger of whether we're hiring or whether we're firing. That number is the lowest it's been since in 10 years. Since 2014. It's the lowest it's been for the number of people hired. It's down, what did I figure, like 14% from its all-time peak in 2022. Yeah,
but be careful what you wish for, is what Dave was saying. I mean, we wanted a slower growing economy. We were still a growing economy, and we wanted the Fed to lower interest rates, which are artificially high and constraining growth. Well, but we're growing at over 2%. So if that's a constraint, help me here. And so the market's got exactly, as Dave suggested, what they'd wanted, and they're complaining about it. It's nuts. So I think this is, we don't know what lies ahead, but we know that the Fed will next lower interest rates, whether it's a quarter or a half, because the markets are going to demand it in September. And then you've got the political overtones. Oh, gee, the Fed is going to lower rates. That's going to help one party versus hurting another. If they do 0.5%, oh my God, I can't believe they're doing that to help whoever. This is pretty normal to me. There are global trends that shift on a regular basis: wars, concerns, oil prices, going higher or lower. But over the long haul, I think this is a tremendous economy, tremendous market. Corporate profits have been continuing to go up. Some disappointment with the earnings of the tech stocks, this week. Some of these Magnificent Seven, aren't as magnificent perhaps as they were before. Some rotation to value stocks that had been undervalued. A lot of people saying, oh, we should move to small cap stocks. There aren't enough small cap stocks, and not, let alone good ones. So this is what we deal with, year after year, day after day, and it just doesn't seem that bad. It seems pretty good.
One of the silver linings, I think, to the labor report is that one of the constraints to earnings growth has been labor costs. Right? I mean, that's what you hear a lot about in a lot of earnings calls over the last 12 months is, hey, labor costs are rising. We got a lot of competition. We're having a hard time finding people. So if we do see a softening labor market as we go forward here, I mean, that is one of the silver linings, is that it could provide some relief to employers on that wage front.
In relief to inflation more broadly. And if the concern is ultimately the Fed's battle against inflation versus the consequence of slower growth, well, maybe inflation isn't quite at target yet, but Powell this week talking about a statement shift in how they talk about inflation from inflation being elevated to now inflation just being somewhat elevated. And for those that try to read the tea leaves on what the Fed is what the Fed is saying when they release those statements, I think sometimes those little word changes can tell you a lot about where they're leaning. Yeah, it's not a done deal that the Fed cuts in September, but it's a lot closer today than it was 2 weeks ago. And even to the point where now a lot of the market maybe believes that, Art, as you were saying, maybe there's 2 rate cuts coming, not just one, and even more than to follow later this year into early next year. As I've written, as we've talked about on the podcast, none of that speaks to a Fed that wants to be accommodative. They just want to be less restrictive. They just want to get closer to neutral. And so if the environment we're in now is, the pressures from wage growth, for example, aren't as bad, or maybe, Art, to your point, this is a fairly normal summer turn that we tend to see. Well, all of that speaks to an economy that doesn't look drastically different today than it did 2 weeks ago, a month ago. We just have a little more data than we did. And, how do we go from one bad week, one bad stretch to what's the rest of the information look like?
Yeah, the information, we look at the data every week, and it has skewed more to the cautious right now. As Dave indicated, the Fed had been looking for this with some less pressure on, wages. And so we do see, as with unemployment going up, hiring going down, as you indicated, this is a good thing. There's less inflationary pressure. And then you get into this distinction between contemporaneous indicators, leading indicators, lagging indicators. The stock market's a leading indicator. Maybe this week it was right, maybe it was wrong. The employment rate is sort of a lagging indicator. And so the Fed wants to be careful so that they don't let things get too weak too soon. And so that's why, and he's telegraphed it, he's pretty much stated it every time Powell's been talking, and now the markets are expecting him to follow through. They're not at all as concerned about inflation. You can just see it. Around the world, you have different issues. England lowered their rates, but they're still concerned about rising inflation, and rising wages over there. So the countries are different. Global economy is different. I was reading an article this week. You can buy these electric cars in China for like the equivalent of $11,000. We're not going to get those because we'll double tariff or, put on 100% tariffs before they get here. But there's global excess capacity, perhaps, that could bring prices down, more over time. And not to mention the election, and the effect of that on consumer psyches. But maybe people are going to get the message that inflation is lower, and maybe they're going to spend more money, or continue spending money. The economy should continue to expand, I would think, at a lower rate, which is what the Fed's been going for anyway.
Certainly the election's kind of the third piece of the conversation, and plenty of reasons why that might unnerve investors near term. But it is about earnings and interest rates. Earnings are coming in more or less where we expected, maybe not quite as great in some areas, but better in others. Interest rates likely to be cut supports higher stock valuations today than maybe it did when rates were a little bit higher. And so I think it's a recipe for, as long as the economy doesn't weaken too much, maybe things are a little expensive right now. We just need a little time to catch up. Joel, some other economic indicators this week maybe worth pointing out. In particular, we look at the consumer almost religiously around here. We got a consumer confidence reading earlier in the week.
Yeah. Oh, I forgot about that one. Yeah. So that comes from the Conference Board. They have consumer confidence. Last week we talked about the University of Michigan and their consumer sentiment number, and they're both kind of at a stalemate right now. They're both kind of steady. In part, there's uncertainty about interest rates. There's uncertainty about the election. They're finding in their consumer surveys that consumers are kind of holding back on their plans to spend money to see what happens on both of those. As you point out in the article that we have in the newsletter going out today, is people don't usually make big spending decisions based on one candidate or another. They, when you're, if I may paraphrase, when you need to buy a fridge, it's more about keeping the milk cold than who's in the White House. But the latest numbers on those are telling us that relative to historical measures, confidence has been low for a couple of years, but it's all kind of wait and see to see what goes on with inflation and what's happening with the Fed and interest rates.
And a little bit of housing data, construction data this week that, some encouraging signs here and there that maybe pricing might stabilize a bit. We've seen some rate moves that might help a little bit as well for home buyers.
Yes, we've seen that, and we've also, and again, holding patterns of buyers, hoping that the rates come down and make a little more affordability as far as the homes are concerned. We also had numbers on manufacturing showing that sector is still weak. The Institute for Supply Management, their numbers have shown that that industry is actually basically in contraction for 20 of the last 21 months. We had numbers today from the Commerce Department on factory orders, new orders. Those are down the second month in a row, and they're weak year to year. But there's still a little growth in there, and there's still no reason for great despair. Actually, the employment numbers show that there was actually an uptick in factory jobs in July, which wasn't expected. So,
maybe a good reminder, you mentioned the newsletter that's coming out. If you're not subscribed, encourage everybody to get to our website and check it out. The new website up and adding content just about every month so that we can get some good eyes on what we put a lot of work into. But most importantly, if you're not getting that newsletter, I encourage you to. Beyond that, maybe happy to put a close on what was a pretty rough week overall. We got a positive day or two in there, but a pretty negative tone. And again, hoping that maybe next week we go back the other direction. We appreciate you listening, and we'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.